Good morning, ladies and gentlemen. Well, as I've been saying for weeks, the model is not going to help us here. It keeps on basically ranging, and the mathematics here have made it go into risk off, but that to me means absolutely nothing. We need to have a really big move in the ratios to have true risk off, and we're just not getting them. I will go through the expectations for the Fed and the expectations for the CPI this week, and I can't see that that is going to change very much in the ratio between equities and bonds, and therefore I continue to prefer equities to bonds. So this week we get the updated dot plots. I would be very, very surprised if we don't get at least most of these people who are down at 460 to go up at least one. So are we going to get one cut or two cuts, or at least are the Fed dot plots going to show one or two cuts? I think they're going to be dependent on CPI, because don't forget they get CPI at 8:30 and then at 2 p.m. on Wednesday they get to give us the dot plots, and since they keep on saying that they're data dependent, well, they're going to get important data, aren't they? It's going to be a toss up between one cut and two cuts depending on the number. I think they should be honest and say that they have no idea and pencil in maybe one cut and then say they are absolutely and completely data dependent. But, they are a political animal because they're a governmental institution, and therefore there is absolutely zero chance they're going to show that there are going to be no cuts. But they are running out of Fed meetings. Don't forget, they only have the one in July, and then the one in September is far too close to the election for them to move. And then basically it's after the election that they can move. I would have thought that one cut in 2024 is what we're going to get. And then the question is, how many do they take out for 2025? I would have thought that four cuts in 2025 is the minimum that they are going to have. But what I'm really looking for is for these dot plots to start moving up, because they have to now recognize that R star is higher than they think it is. And to have these dot plots around the 2.5 to 3 longer run, to me makes no sense. They have to start taking the 2026 and the longer run dot plots higher towards 3%. I really wouldn't be surprised if all these people moved up to 3%. It is just what it is. It's impossible to have an economy which continues to run as hot as the American economy is and have the longer term dot plots down at 2.5%. They have to recognize that something has changed in the longer run. Now, if that longer run is 5 years or it's 50 years, that's a matter for economic debate. But what is not a matter for debate is that the economy continues to be far stronger than they ever predicted, and that the likelihood is that it continues so until the data shows otherwise. In which case, why have these dot plots down at 3%, when to me it's becoming quite obvious that the cutting cycle is going to be far shallower than they first thought. I would have thought a cutting cycle down to 4.25% is all we're going to get, and therefore the curve should react to that and steepen. But it isn't so far, and I might be wrong still, but I, with all my strength, believe that the curve needs to steepen. So what happened in the bond market last week? Well, we had basically 4 days of silliness in which everyone was convinced that the Fed was going to cut. I have no idea what they were thinking. And then in one day, because of the NFP data, they just took out everything that they had priced in the previous few days. And really, we closed very much unchanged on the week. Now, if you solve for what I think is the worst case scenario, which is one cut in 2024 and then four cuts in 2025, starting the cuts in, let's say, November, just after the election, but it doesn't really make that much difference. The break-even price for twos is around 508. So to me, the odds of twos going above this area here are almost zero. There is no chance that the Fed is going to go to no cuts in 2024, not after we had the ECB move, and we expect the Bank of England to move. It's just very, very unlikely. So the odds are never zero, but around this 508 to 510 area, I will be loading up with twos, because I think they will be at what can only be described as, the terminal rate to the upside, if there is such a thing. I think the risk reward around 505 to 510 is enormous. And, there will be stops around here, which should carry it a few basis points. And I think this 508 to 510, if the dot plots are, what I've described, is about as far as the twos can go. And once the twos are at that level, then any bearish news can only hit the longer end. And then I expect that all the curve can do is steepen, because I think the odds of them then pricing in hikes by the Fed are almost zero. And where can the twos go if there are not going to be any hikes? Well, they're not going to go any higher than the current Fed funds rate. So I think it's very unlikely that we even see 520. And I'm not talking about next week. I'm talking in several months. I think it's very, very unlikely, unless the data is enormously strong, that we have even 10 basis points of risk on the twos, and I will be buying huge amounts. My argument as to why I don't like the rest of the curve is not so much that it's expensive or anything, but it's why buy it. If I am correct, and this cutting cycle is going to be far shallower than the previous cutting cycles, unless something breaks, okay, and that we cannot forecast. But if something breaks, guess what they cut? They cut the Fed funds rate. They don't cut the 5-year note quantity issued. And they don't cut the 30s, and they don't cut the 10s. They cut the Fed funds rate. And that's, when something breaks, it's far more likely that the curve does what? It steepens, it doesn't flatten. To me, there is no argument for buying 5s, 10s, and 30s, because the supply is there. And it can only get worse over the course of the next couple of years. What we do know is that the Fed is desperate to cut, just like the other central banks. They might be hawkish cuts, but they're cuts. So we know the upper level of the 2-year note. We know where it's anchored to the upside, and I've just showed you that. If you solve for one cut and in 2024 and 4 in 2025, giving you a shallow cutting cycle towards 4% terminal rate. In that case, why would anybody want to buy 5-year notes at 4.45? What are you ever going to make out of it compared to the risk that you are running of the supply and the drip, drip, drip that should take it to a positive yield curve? It just doesn't make any sense to me. So now, what can happen next week? I really don't see how 5-year notes or the 10s or the 30s can do anything but go up towards their highs and stay up there. I just can't understand why anybody would prefer to have duration, long duration, when they can have short duration at a higher yield. But I've been wrong so far, and I'll probably continue to be wrong. To me, twos, tens, as soon as we've got to these levels, any kind of risk reward of being, looking for the flattener, it just doesn't make any sense. As soon as the twos are at terminal rate, which I showed you, it's about 508, 510 to the upside, I just can't see that the curve can do anything but come back down and steepen. 530s, I mean, it's doing nothing. But again, I expect everything to eventually roll over. I will sort of die on this hill kind of thing. I will not die on this hill in monetary terms, but I will always try to only put on steepeners from now on. In Europe, the ECB cut, and what happened? Nothing. The market is basically saying that the cutting cycle is going to be shallow there as well. And if the cutting cycle is going to be shallow, then everything is still expensive or it's not cheap. This is the Schatz, and the one that should have been most affected by the cut. And really at the end of the week, what happened, and I can show you on a weekly basis, nothing. I mean, it closed exactly where it opened. And it's interesting on these weekly charts because I think that the Schatz, if the 2-year note goes to that 508 level, you can go to up here, 317, 318. And I think that very much like the 2-year note is a big buy at 508, 510, the Schatz is a big buy at 318. Because there's no way that they're going to not build in some more cuts from the ECB, data dependent and all that. But still, we've started the cutting cycle, which should continue for, 6 months, a year, in which case 318 becomes, if you solve that for 3 more cuts from the ECB, 318, 320 becomes the level that you want to buy in the 2 years. Now, the pressure should be a lot less in the 5s and 10s, but still it's there. You can see that even that is being pressured to the upside, even though they've got far, far less issuance to worry about. Where would you buy 5s? Well, you wouldn't want to buy 5s as much as you would want to buy the 2s. And so to me, that curve needs to steepen as well. 2s, 10s didn't do anything at all. But if you see it go up for whatever reason, I think as well this curve is likely over time to basically go down towards this 25, 26, because I don't see any alternative to a shallow cutting cycle from the ECB, just like I don't see an alternative to a shallow cutting cycle from the Fed. To me, if you see up here, then you will get out around this 26 area, and one day it'll break, but it'll only break if something breaks, and it's going to take a long time. You can see how many weeks we've been in this 20 basis point range, and we're likely to continue. Just like last week, please look out for this 324, 325 level in the oats. I think it's going to be a very, very interesting buy, or at least what you do is you buy some Bund calls, because there are no options of this damn thing that trade. But I think this is going to be a very interesting level. if I paint a scenario where the Fed disappoints the bond longs, or the auction doesn't go all that well, and everything is forced up to this 324, 325 area, I think that's going to be a very interesting area to buy some Bund calls. Have that written down, alarm set, and wait for it. And on the crosses of the yield between Germany and the US, this is intense. I think all the risk reward now is going to go to, go to around 187, i.e. another 4, 5, 6 basis points from here. We are in a range now, probably 172, 190, just like we were here. And I just don't see why people now would not prefer Germany to the US. At least they know that the cutting cycle there has started and is probably going to be, I wouldn't say deeper than the US at some stage, but at least it's there. While the US, you never know if there's going to be one at all, kind of thing. So the certainty should drive people, if not into bunds, then more into oats or the Italian bond, which now has positive funding. And that is going to keep the bunds far more stable, or in a relationship to the Italian bonds or to the oats, than the 10-year treasury. And therefore, plus if you factor in the lack of supply relative to the US, you should see this move back up to this kind of level 187 over the course of next week. So that to me is the trade. One here to look for 10 basis points, 7 basis points, whatever. Well, actually that's 6. The other trade that I'm really interested in is the oats, as I just showed you. The dollar, well, I just showed you the differential between the bunds and the 10-year. And if I'm correct and it goes towards that 186, 187 area, I would expect the dollar to trade up here at 105.40, and that's about it. That is going to be a very, very important level, which we can probably get to, I don't know, Monday, Tuesday, and then back off and wait for the Fed. And then depending on how hawkish the Fed is, we could go probably back up to this kind of 106 area. But I really don't expect fireworks. Not yet. I just don't see why that would happen yet, because I think the relationship of the interest rates is not going to go a million miles, as I showed you. I think that 172 to 190 is basically the range between 10s and bunds. And until that breaks out, it's very unlikely that the dollar can do major things. So if you want to get long of the dollar for, I don't know, something like 105, 30 to 50, yeah, I can understand that, but I wouldn't be long above there. As you can see in the Euro USD, we are very unlikely to be very far away from this 107.80 to 108 area when the Fed comes out with its announcement, or when CPI happens on Wednesday. So I would have thought 2 or 3 days of going sideways, and then we see. I really don't think that this technical setup says that we're about to break these levels. It's going to take some time. It can take place towards the end of the week, but not immediately. And I think the FX market is going to be content to do next to nothing until Wednesday comes around. Gold has not been trading well for a couple of weeks. I think that gold could have a bit of a nightmare over the course of the next 1 or 2 weeks. And the level that I'm looking at is something around this 22.05 to 22.10 area as its ultimate destination. Now I'm going to tell you why I think that is going to happen. We had this announcement from the Chinese on Friday that they didn't buy anything during the month of May. Why have people been speculating to the upside in gold? Well, they've been speculating because the central banks, i.e. the Chinese, are buying gold. So that removes that, and basically they've been front running them. So that removes that one stool of support. But the other stool of support is the relationship between real rates and gold, which has not made sense to me for a few months. And let's have a look at that, and let's see why this 2200, just above 2200 level, makes sense as the ultimate destination of some sort of an ABC or whatever pattern you want, but in fundamental terms why it makes sense. You will remember that on whenever it was Thursday, I commented on the Lagarde comment about real rates. I know that this is in the US, but the point stands. She commented that real rates were now higher than they were in September of last year. So, okay, this is September of last year. This is what real rates did. To me, that was significant because I think that the central banks started getting very worried when real rates moved above 2%. They were quite content to see them trending towards 2%, but once they started breaking and accelerating from 2% to 2.55, they got slightly worried. And I think that they have an agreement to basically try and keep real rates at 2%. Maybe they are thinking like this: 2% is restrictive, but it's not overly restrictive, and therefore we are minimizing the chances of something breaking. We are keeping restriction on, but we are not making it so restrictive that something is likely to break. That tells me that they are going to try to keep real rates around this 2% area in the US. And now let's have a look at the chart of gold against the tips. Now, as you know, tips give you what do they give you? They give you 2% over CPI. And if gold gives you CPI, then it would make sense that this last leg that we've had of gold outperforming CPI should get retraced, and it should get retraced to these levels. And if we say that the tip price is going to be constant around that 2% level, then we get this area here, and this area here, if you have a look at gold, is exactly what it traded when it was like 2200, 2225. So that is where I think the technicals and the fundamentals marry up, and it makes sense to me that gold is going to get sold, because if you're not front running the Chinese anymore, and they could be buying through nominees, I have no idea, and I think nobody can have no idea about what the Chinese are up to. That makes sense to me that that is the kind of level that we go back to in the relationship between gold and real rates. I always will prefer real rates because I'm not Chinese, and 2% to me is always going to be infinitely better than 0%. But, if the Chinese need to buy, the market is always going to be supported. But where should a retracement take place? Well, to these levels. DBC, another reason for gold to go down, but also DBC is weak. To me, this 2175 area is what must hold. It absolutely has to hold. But while DBC and therefore oil and therefore everything else is this weak, all one can say is that bonds are not going to go a million miles. So let's try to put it all together. You have a Fed which doesn't know how far or when the cutting cycle will start, and that is why you will want to buy as many 2-year notes at 508, 510 as you possibly can. But also you have a situation in which inflation is very unlikely to reaccelerate. I can't imagine what would cause inflation to reaccelerate with DBC and oil this week. Basically, they are at the same price as they started the year. So, an acceleration of inflation, which to me is the only thing which is going to even remotely force the Fed to abandon the idea of cuts, i.e., go to completely neutral, i.e., flat, zero cuts for as far as the eye can see, let alone go towards hikes. I think hikes this year, whatever the data show, are science fiction, because A, it's we all know what's going to happen in November, but B, it's terribly unlikely that they need to talk about hikes, simply because DBC and commodities are doing what they're doing. This is not 2022 when or 2021 where commodities are just going one way. This is a very stable period where I just can't see what is going to cause an acceleration of inflation. Inflation might be slightly more stubborn than the Fed likes. It could be zero point 0.1 outside of a range, but it's not going to be 0.2, 0.3. There is going to be no acceleration here. And therefore, the upper ranges of the bonds are buys. Let's start our look at equities with the clean chart, my clean chart. And I defy anyone to tell me how this is a bearish chart. I just can't see this as a bearish chart at all. Again, just like last week, I'm going to tell you that only closes below 52.55 give you any kind of indication that anything bad could be on the horizon. And what did we do last week? We tested it very briefly and up we went. And really the only thing that it's stopping this going even further is the weekly Bollingers, which I'll show you later, which are basically saying that we're going to have some consolidation for another 1, maybe 2 weeks. And then I think it's going to be the tech sector that takes us higher. It's just very unlikely that equities are going to be particularly bothered by anything until and unless the bond market starts breaking ranges to the upside. And I don't think that that is likely to happen. I think that once the twos have got to the levels that I mentioned, once the curve starts steepening from there, that's all you're going to get. You're going to get the top of the range and then the twos back off, and then the 5s, 10s and 30s stabilize towards the middle of the range. They might bleed with supply, but it's not going to go a million miles. And for us, for equities to start breaking, I think that it has to be led by bonds going 40, 50, 70 basis points higher. And I think that at the moment, with the Fed in the position that it's in, that it's threatening the start of the cutting cycle, is very unlikely. There isn't a single risk indicator that I look at that is overstretched by any means. This is ITOT over government, so the totality of the bond market against the totality of the stock market. SPY over SHY, SPY over IEF, SPY over TLT, SPY over XLY. I mean, none of these charts are at some spiking extreme. We are where we have been since April. We've just basically been going sideways in the relationship between the risk assets, and that is not bearish. What would be bearish if we start breaking some level like this one, 525, and saying that all this area is going to get taken out. But that's not going to happen unless we start having bonds doing better and equities doing worse on the back of what? On the back of a weakening economy. We're not having that. We're not getting it. And therefore, I just can't see why anybody would prefer bonds over equities because of the supply situation and because of the balance sheet situation. Equities just have a better balance sheet than the US government. It's just as simple as that. And I know that the US government can always print and can always tax and can do this and can do that, but it's just not going to do anything. It's not going to do any of these things for the foreseeable future, and therefore, for the time being, equities are a much better bet than bonds. I am getting pretty convinced that the Nasdaq is the one that is going to surprise us to the upside. So let's have a look at this chart. This is the 195 minute, and that's the weekly. I've been saying that unless it starts breaking 18,450, and then the target is only 18,205, and really that it needs to break that to start looking even slightly bearish, then the likelihood is that we start bumping our heads against the weekly Bollingers, go a couple of weeks sideways, stop some people out by having a quick dump, and then we just power ahead. Now, I know that that would need Nvidia to start going up again, but maybe the leadership is going to be taken out by something else. So I'm not going to go into which individual stock is going to help us out, whether it's Microsoft, Apple, Amazon, who cares? I think that the likelihood is that we spend a week going sideways because these Bollinger Bands will not allow us to go much further. Then probably another week with a nasty little dip, maybe that all the way back down to 18,206, and then we just power ahead towards 20,000, and we see 20,000 by in a month's time. I think the Nasdaq is the one that will keep on powering ahead. When a market does this and it just keeps on hesitating at the top of the Bollinger Bands and then goes nothing but sideways for a couple of weeks, that is a sign that it's ready to explode again to the upside. We know what to do if we get a retracement next week on the back of the Fed or the back of who knows what, CPI or whatever. At these levels, you want to buy some 3 to 6 month calls. I think there is no reason not to expect that this will be the leader for the next 3 to 6 months. The foreign markets, whether it be Japan or EEM or even the stocks, are in a period of hesitation. And that is why I don't think that equities go up right now. I think the US is going to hesitate just as much as they are. But that is why I think that if it's not the traditional sectors, it will be tech eventually that takes us up, and these markets don't have a lot of it. To me, the Nikkei at the moment is dead money. Just leave it alone. It's just going sideways, and basically it's going to be very difficult to make money out of it. This is the stocks, and it keeps on hesitating at this 5,077 area. I think you leave that alone. I think it's just going to range for a bit. And eventually, I still think it powers higher, but I don't think that the time to buy it is now. And if we look at EEM, much the same thing. I really want to see it back down to this 39.93 level, and there I will be prepared to buy it. But to me, you leave EEM alone unless it trades 39.93, and also you leave Nikkei alone for the time being, and the stocks. I know I prefer the stocks to the Nikkei for now, but I think it's going to be hard work for everything. The US is the one where the exceptionalism will continue, and I am going to concentrate on NQ for the next couple of weeks, looking for levels to buy some long-term calls, as I told you. So what should we be concentrating on next week? Twos, if we get put in 507, but if we get 507, 508, I will be a big buyer. The other one that we should be concentrating on is this 325 area in 08s. I think that could well be the top and would be worthwhile buying some Bund calls because, as I said, 08s, not much luck with options there. And the other thing that one should be looking for is basically bounces in gold to buy some put spreads, with the bottom being probably 2260 next week, but 2210 eventually. I think that that is far more likely to happen than we are to go even above 2340 next week. Thank you very much indeed, and tweet you tomorrow.